All right, welcome to The Explainer. Today, we're going to put on our financial detective hats. We're going to look past a single, really popular number to find out the real story of how a company actually makes its money.
So let's kick things off with a question, a puzzle really, that trips up a lot of investors. You're looking at a company and you see it has a 20% return on equity, or RoE. On the surface, that looks fantastic, right? But what if I told you that number could be a total trap hiding a massive risk?
You see, on the surface, two companies can look exactly the same. Both Company A and Company B are showing off that shiny 20% ROE. But underneath that one number, one of them could be a really high-quality, sustainable business, while the other is basically a house of cards, just waiting for a gust of wind to knock it over.
So, how do we tell them apart? How do we spot the safe bet from the risky one? Well, the solution is a really powerful framework, a kind of detective's tool called DuPont analysis. It's what lets us crack open that ROE number and see what's really going on inside.
So what is DuPont analysis? Well, here's the beauty of it. It takes that one big number, ROE, and breaks it down into its three core ingredients: how profitable the company is, how efficient it is, and how much debt it's using. It shows us whether that impressive return is coming from the company being genuinely good at what it does, or if it's just juicing the numbers with a ton of risky debt.
All right, let's open up this detective's toolkit, shall we? The formula itself is built on three distinct clues that, when you put them all together, give you the full picture of a company's performance.
Okay, here's the formula. And I know, at first glance, it might look a little intense, but stick with me, because we're going to break down each of these three parts: profitability, efficiency, and leverage. And each one tells a simple but really crucial part of the story.
And you know, there's actually something kind of elegant about the math here. See how sales in that first part and sales in the second part just cancel each other out? That's not just a trick. It mathematically connects a company's profitability directly to how well it uses its stuff, its assets. It proves these things are deeply connected.
All right, so let's investigate these three clues one by one. We've got profitability, efficiency, and leverage. Our first clue, net profit margin. This is all about profitability. Think of it this way. For every single dollar a company makes in sales, how many cents does it actually get to keep as profit? A high margin is a fantastic sign. It usually means the company can charge what it wants and is really good at keeping its costs low.
Clue number 2 is asset turnover. And this one is all about efficiency. I mean, how much bang for the buck is the company getting from all its stuff? You know, its factories, its inventory, its equipment. High turnover tells you you're looking at a well-oiled machine that can squeeze a whole lot of sales out of every dollar of assets it owns. And our final clue, the equity multiplier. This is the big one. This is our risk detector. It tells us how much the company is relying on debt, on borrowed money to finance everything it does. A high number here can pump up the returns, for sure, but it also massively increases the risk. Okay, we've got our tools. We understand the clues. Let's go back to our original mystery, those two companies that both had a 20% ROE. It is time to crack this case wide open. And this is where it all clicks into place. Look at this. Three totally different companies all get to that same 20% ROE, but they take completely different roads to get there. First, the software company. It gets there with incredible 25% profit margins. It's so profitable, it doesn't need to be super efficient or use debt. Now look at the retail chain, a totally different story. Its margins are razor thin, so it has to survive by being incredibly efficient, turning over everything it owns 3 times a year. And the manufacturer? Its margins are okay, its efficiency is average. So how does it get there? It pulls the leverage lever hard. So here's the bottom line. The final number, identical. But the story, and more importantly, the risk, completely different. The software company's return is high quality and pretty low risk. The retailer's is solid, built on being great at its job. But that manufacturer's return, it's fragile. It's propped up by a ton of debt. But hold on. This tool, as powerful as it is, isn't a silver bullet. You absolutely have to know its limitations to know when the clues might actually be lying to you. For starters, it just doesn't work for certain types of businesses, like an asset management company. Think about it. They manage billions of dollars for their clients, but they don't own those billions. So their own asset base looks tiny, which makes their asset turnover number artificially huge and basically meaningless.
And you can put banks and other financial firms in that same category. Why? Because a bank's business is just fundamentally different. Its main assets aren't factories or equipment. Its assets are the loans it's made. The whole model is different, so our clues just don't apply in the same way.
And lastly, you got to be really careful with a lot of modern asset-light businesses. For a huge tech company or a business with a powerful brand, what's its most valuable asset? It's the code, the brand recognition, the reputation, and you know what? None of that stuff is on the official balance sheet, so the DuPont numbers can get skewed.
Okay, so where does that leave us? How do we take all of this and actually use it to make better, smarter decisions?
Look, if there's only one thing you take away from all this, let it be this. The story behind the ROE matters so much more than the number itself. Your goal isn't just to find a high ROE. It's to find a high-quality ROE that comes from sources you can actually trust. The way professionals look at it is like a quality scorecard. They give the most points, the most weight to those sustainable profit margins and that solid operational efficiency. That leverage part, they see it mainly as a source of risk that they need to watch like a hawk, not as the main driver of returns. And this gives us a huge red flag to watch out for. If you ever see a company where its profit margins are shrinking and its efficiency is falling, but its debt level is steadily going up, be very, very careful. That is the classic sign of a business whose core is getting weaker and it's trying to hide it by piling on debt. So, there you have it. You now have the tool to look past the surface-level numbers and find the real story. You can separate a high-quality company from one that's built on high-risk financial games. The only question left is, the next time you see a big, shiny ROE, are you just going to look at the number, or are you going to dig deeper and find the story behind it?